Thank you everyone on the webinar tonight for attending. I know we probably have um, many individuals on the webinar tonight who have never heard of Marshall Reddick Real Estate, um, and maybe others that have never invested in real estate, up to seasoned investors. Regardless, I'm hoping tonight will be a good jumping off point, um, whether you have or have not invested in real estate, in helping to determine what real estate investments are going to be best for you, and how to properly evaluate them. Because I think we can all agree that not all real estate is made the same, and determining where to invest is incredibly important, as is determining what to invest in. So before we get into it, just a little bit about who we are at Marshall Reddick Real Estate. We're a full service real estate brokerage. We offer three primary services. As a real estate brokerage, we help our clients to invest in real estate, both in the state of California and in 16 markets across the country. Now that might challenge beliefs a little bit, because most of our attendees tonight are probably located within the state of California. Uh, but truth be told, you have access to essentially every real estate market in the United States of America, some being better to invest in than others. And as long as you're able to properly evaluate those markets, evaluate the investments within those markets, you can determine whether they make sense for you, your personal goals, and your portfolio. At Marshall Reddick Real Estate, we're also a property manager, and a private money lender. But within the 16 markets that we operate, we have full teams, not just myself as an advisor, not just a realtor in those markets and a property manager, but a lender, a preferred lender, insurance agents, tax advisors like Tony, that will help you adequately evaluate and acquire investment property that ultimately suits the financial goals that you have set for yourself. Quickly about me, and there's a lot of information we're going to pack into a short amount of time tonight. So if I'm moving a little quickly, I do apologize, but all of the information presented tonight will be available. I'm happy to send over the slides and any additional information and resources we talk about. Myself personally, I am a real estate investor myself. I've been a real estate advisor at Marshall Reddick Real Estate for 3.5 years. And so I've helped investors from beginners all the way to seasoned investors invest in multiple different types of real estate investments in all 16 of our markets. Really getting to know specifically what it is you're looking to achieve in investing, to help identify a market or markets and investments within that market that are going to make the most sense for you. So today we're not only going to talk about establishing our own criteria, we're also going to discuss how to properly evaluate a market, how to properly evaluate investments within those markets, and determining what it is you're looking to achieve, specifically quantifying your goals. We're going to be able to determine what markets make sense for you, what investments within those markets make sense, and then the steps to acquire those investment properties. And we have two investment property examples that we're going to take a look at this evening. We're going to go through the financials, and we're going to discuss metrics to use depending on what you're looking to accomplish as an investor. Really quickly, we do have a couple poll questions. This just helps us better understand who we have on the webinar tonight, and the investors essentially that are listening in. Please note that this poll is completely anonymous, but like I said, gives us an idea of who we have joining us tonight. So first question being, how many rental properties do you currently own? Okay, It looks as though the majority of us haven't invested in real estate yet, and that's phenomenal. This is going to be a great jumping off point um, to determine where and what to invest in. And then we have about 30% of us that are already investors, and some of us have quite established portfolios. So a really good mix on the webinar tonight. As an advisor and working with clients, the first step in the entire investment process is determining why it is that you're looking to invest in real estate. Now, let's explain that a little bit. Some of you maybe 20s, 30s, might have years of work ahead of you, not planning to retire anytime soon. Have a salary, don't need a little bit of extra cash flow every month. In that sense, those investors are probably looking for the highest return on investment possible. Whereas some of you on the webinar tonight are closer to retirement, might have a 401k, might have a pension, but ultimately are going to need to supplement income you've had from working as soon as possible. And in that sense, maybe it's not the highest return on investment. In other words, maybe it's not the highest amount of appreciation that you're looking for, but the highest amount of passive income. In other words, cash flow and cash on cash return. So I want you guys to remember those two metrics, return on investment and cash on cash return, because depending on what it is you're looking for, one of those two metrics are going to be most important in evaluating investment property. But the first 5 steps that you see here are all determined by you as an investor, the amount of money you're looking to invest, your ability to qualify, the types of returns that you're looking for before we get to who, and that's introducing you to everyone that you need to acquire an investment property. Now, we talked about this already a little bit, determining your why, what it is that you're looking for. Some of you might be looking for passive income. Some of you might be looking to pay a child's college tuition. Some of you are simply unhappy with the returns that you're seeing in the stock market. And answering the question of why will help lead to a specific market and a specific real estate investment within that market that's going to make the most sense for you. Your answer to the question why is going to help to determine what specifically you invest in. Different real estate investments behave differently. Single family properties typically appreciate better than multifamily, but multifamily properties typically cash flow better. So depending on what types of returns you're looking for will determine what types of properties that we should be focusing on. All of us have different budgets and different price points that are going to be most suitable for us. And there's one point there, property class, that I want you to pay attention to, because if property class isn't a term you're familiar with yet, we're going to be introduced to that term in just a bit, and to discuss why it's important to classify property in any market that we're evaluating. And condition, guys, I would say is not quite as important in determining what you're investing in. Sometimes you can find what I like to call the worst property in the best neighborhood and get a little forced equity. But for more passive buy and hold real estate investing, a lot of us don't have the time to set aside to renovating or rehabbing and like a more finished product, a newer construction home, a renovated home, in order to place a tenant and start collecting cash flow as soon as possible. After answering the question or determining for ourselves what it is that we are looking to achieve in investing in real estate, we can really dig deeper. We start with answering whether we're looking for income or long-term wealth, but then we can put a full plan in place. When are we looking to retire? In other words, when are we looking to switch from a return on investment portfolio to a passive income portfolio? When are we looking to switch from appreciating assets or higher appreciating assets to assets that are going to pay us more tangible returns in the form of cash flow? Experience is incredibly important because experience, I would never recommend someone jump right into an apartment building. You learn the most on your very first real estate investment. Risk tolerance. We're going to take a look at a couple different markets tonight, and you'll see that historically speaking, not all real estate markets behave the same way. Some are very volatile, appreciate and depreciate depending on the global and the national economy, and some are incredibly stable, like markets in Texas that have very little volatility. Even in 2008, saw rates of depreciation at 1 or 2% as opposed to 30 or 40%. Financing is incredibly important. Not all of us are going to utilize financing, but especially in today's market, I definitely recommend it if you can qualify and if you have those options available to you. But there's other forms of financing, private financing. There's cash investments. You can invest with your retirement fund. So we'll talk a little bit about that, and of course your specific budget. Now, like I said on the slide determining what we're looking to invest in, we'll talk a little bit more about property classes specifically here, because part of your criteria is what property class is going to make the most sense for you. In other words, once you've set your criteria, you will be steered to a specific class of property within a market. Property class is important because it tells us the experience that we're going to have in owning the investment that we acquire. Every property in every market will fall into one of 5 of these categories. And I want to be pretty clear that when we're talking about A, B, and C class properties, none are better than another. They're just different. And the further you go down the scale, the higher the rent to price ratio is and the better the cash flow. On the flip side, the higher you go up, the closer to A class properties that you go, the better appreciating those properties are going to be, but the lower cash on cash return that they're going to have within a specific market. So determining which class is best for you is going to be determined by what types of returns that you're looking to hit specifically. Also, this information is really important because it's going to help us use metrics in evaluating real estate investments. Now we'll talk a little bit about that coming up here pretty soon, but it's important to note that we stay within the A to C class range. D class properties are usually the worst properties in the worst neighborhoods within a market, meaning that the returns look great on paper from a cash on cash return perspective, but these are the types of tenants that may get up in the middle of the night, never to be heard from again. They typically don't take great care of your property, not as attractive to families and long-term tenants, which is what we're looking for. Whereas luxury class properties do appreciate well, but typically the mortgage that you're carrying on these properties is so high that it's difficult to cash flow. Your market rent will not cover your fixed and your variable expenses. So how do we classify property? Well, let's start with every major metropolitan area in the United States of America. This is a map of all of them, essentially, and this is where a lot of the data that we're going to be reviewing tonight is coming from. This map here, this is an interactive map that I'm happy to provide to all of you. It's in our property rating ebook, which we'll get to here relatively shortly. But clicking on any one of these properties is going to give you the median home price of that specific metro. And based on that median home price, you can classify a property within this scale. And it's important to note that, and why it's important to classify property as well is because take a market like Dallas, for example, with a median home price around $250,000, essentially means that any property on the market in Dallas listed at $250,000 is going to be right on the A to B class scale. Depending on condition, depending on school district ratings, it can go either way. But in Dallas, a $250,000 property is an A or B class neighborhood. So great schools, better neighborhoods. Whereas a $250,000 property in LA, Orange County, if it existed, way on the D class scale. So it's important to classify properties based on the median price point of a market, because not only do all markets behave differently, they're also at grossly different price points. So determining your budget, types of returns that you're looking for, we're going to find ourselves somewhere along this scale in any given market that we're discussing. And like I said, the class of property that you invest in tells you as an investor the type of experience that you're going to have investing in that property. The class of property determines the type of tenant you have and the type of reserves that you have to allocate to maintenance and vacancy. Now, maintenance and vacancy are your variable expenses, as opposed to fixed expenses like taxes, insurance. Um, Maintenance and vacancy need to be factored in to your evaluation of any investment property, because they will certainly happen. It's not a question of if, it's a matter of when. So in order to accurately evaluate real estate, you have to factor in maintenance and vacancy reserves, which are a function of the property's class. And here specifically, we have the percentages of your gross rent that we're going to allocate in our evaluations depending on the property's class. And like I said, we're going to go through real life examples down the line here. But the lower you go in property class, the more of your gross rent you should allocate to maintenance and vacancy. To adjust the numbers conservatively, so that you have a more conservative and a more realistic idea of the returns that you're going to see investing in a specific property. And down the line, when we evaluate properties specifically, you're going to see how those factor in to the returns, both as a matter of cash flow and as a matter of total return on investment. Because it would be misleading to say that your cash flow is simply a function of your gross rent less your fixed expenses, and not to take into account any period of time that your property may be vacant. Or of course, we would like to reduce vacancy, but eventually a tenant's going to move out and another tenant's going to have to move in. And the period of time between those is going to be a vacancy where you are not collecting a rent. Same with maintenance. You may go, depending on the type of property that you invest in, 1, 2, 3 years without any significant maintenance expenses, but you could be down to year 4 or 5 and have to replace an air conditioner or a heating system. But if you're properly accounting for those types of expenses based on the type of property you're investing in, your evaluations, your financial projections are going to be a lot more realistic, conservative, and accurate. So what does that translate to? We are very conservatively estimating that an A-class property is vacant about 1 month a year. Now your tenant will probably sign a 12-month lease, some might renew. So these are on the more conservative side. Your actual experience might be lower, it might be spot on, but there's no way to determine specifically how much maintenance or vacancy that you're going to acquire throughout the life of your investment property. So using conservative numbers will hopefully put you in a position where your financial projections or your actual experience, your actual returns exceed your financial projections. I know we went through the concept of property class relatively quickly here this evening, but I do want to stress that we have a property rating ebook. It's a short but incredibly comprehensive read that goes into an incredible amount of detail of regarding evaluating markets, evaluating properties within those markets, and what property class really means. And so we're going to start talking about different markets that might be suitable for different investors. Again, challenging beliefs or preconceived notions a little bit, because some of you may have logged on to tonight's webinar with the assumption that it is advantageous to invest near to where you live. That may or may not be true depending on the types of returns you're looking to hit, depending on your budget. Essentially, if you have the right team in place and are evaluating properly, any market within the United States is available to you. However, not every market in the United States is created the same, and not all markets are great for investment. So it's important to, before diving in and evaluating any specific property, that you evaluate the market itself and determine that that market is suitable for investing. So these are the 6 criteria that we use before we promote a market to our investors and essentially establish a team in that market. Job market and vacancy rate essentially hand in hand. The stronger the job market, the lower the vacancy rate in any given market. And the stronger demand for jobs, the more qualified tenants are coming to any given market. And qualified tenants moving to a market or attracted to a major metropolitan area, like I said, will reduce that vacancy rate to keep your rental units leased for as long as possible. Economic diversity is incredibly important. We are avoiding markets that are too heavily dependent on one industry. We want a major metro that is well diversified. The easiest example that I can give, and I apologize if anyone on the webinar tonight is from Detroit, but the auto industry in Detroit. It had devastating impacts not just in the job market, but the housing market within Detroit, because it was too heavily dependent on that one industry altogether. The fourth point, in terms of housing affordability, may resonate with many of us on the line tonight, especially in California, in Southern California, and the Bay Area, is housing affordability. We have some of the highest median home prices in the United States here in California. However, in many other markets across the U.S., the median home price is significantly less, and the rent to price ratio is far better. So you can see a greater return on your initial investment. And then strong education, simply strong academic institutions within any major metropolitan is going to create qualified, first of all, qualified candidates for jobs in that market, but by default, future tenants. And then property management. This is, in my opinion, the most important of the 6 criteria, because property management is a make or break factor in investing in real estate. And a poor property manager can turn a great real estate investment into a non-performing one. So towards the end of this presentation this evening, we're going to share what separates great property managers from poor property managers. These are our 16 markets that we've identified based on the 6 criteria we discussed as great real estate markets. to invest in. And you'll see that there's red boxes surrounding several of those markets. Those are the markets that we have brick and mortar offices where all of our leasing agents, regional reps, or buyer's agents and property managers are working under the Marshall Reddick umbrella in our brick and mortar offices. And in the rest of our markets, we work with referral partners. But regardless of whether you invest in a market in the red box or outside of the red box, experience is much the same. And we have a complete team to help you identify and evaluate and acquire real estate investments within these markets. You'll notice, however, that if you've browsed on our website before, many of the real estate investments are not within the city center themselves, but within the suburban areas of any major metropolitan area. Now, why is that? We're following the path of growth. As you expand from city center, you're going to run into more suburban areas that have newer homes, better schools, more attractive to families and long-term tenants. And that's what we're really looking to achieve. Newer properties are going to have less maintenance. And of course, families and long-term tenants are going to reduce your vacancy, ultimately making your real estate investment as profitable as possible. And these are just the maps of a few of the major metros that we're in. Now, we always recommend investing in a major metropolitan area as opposed to smaller regional areas, or especially avoiding college and tourist towns, because there's safety in numbers. You have a larger tenant base, you have more job opportunities, higher potential of growth, but that middle point is the most important point on this slide. You have the ability to shop property managers, and that's incredibly important because if you invest in a market where you only have one property manager, then you have no choice but to use that property manager, regardless of their service, regardless of their communication, regardless of the fees that they charge. So in larger metros, not only do you have a larger tenant base, you have probably greater appreciation in your investment, a larger supply of homes to choose from, but you also have your choice of property manager, which means there is competition within the industry, which is incredibly important to your bottom line as an investor. We touched on this a little earlier, but within a major metro, as within a suburb in a major metro, within the path of growth, you're going to see better school ratings, lower crime rates, ultimately all points that are more attractive to long-term tenants. Now, those criteria that we had discussed a little earlier, those 6 points, those are outlined in great detail in our market data packets. Now, this, in addition to the property rating ebook we talked about a little earlier, all available on our website, all available completely free. In fact, all the mentoring and all the education at Marshall Reddick Real Estate is completely free. It's our philosophy that your money should be allocated to your real estate investment, not the education. So if there's markets that you're curious about, I highly recommend hopping on our website, taking a look at these market data packets, looking at other recorded webinars, and educating yourself about real estate markets that you may not have thought available to you as an investor before. And certainly, I'm more than available to send this education and information over to you as well. In fact, I would love to. So following this webinar, you'll have my contact information if there's anything specifically that you see that you would like sent over immediately. This is just a snapshot of our Learn page, an encyclopedia of real estate You can spend hours on this website going through articles, market data packets, and I definitely recommend it. There's a wealth of information available. I just want to touch on this point here because a lot of us, especially as first-time investors, are going to utilize conventional financing. And we're not going to go too much into the requirements of taking a conventional loan or what that entails tonight. Um, but if you're in a position where you cannot qualify for conventional financing, or you have equity in your primary residence or other investment property, there's other options available to you. If you cannot qualify for conventional financing, you can utilize private financing. Some of us prefer to invest in cash to maximize our cash on cash return. Some of us would like to utilize equity in our investment property so we can do what's called a 1031 exchange and move that equity tax deferred into more real estate. You can certainly tap into the equity in your primary, um, but I do want to point out that you as investors also have the ability in many circumstances to utilize equity that you have in your self-directed IRAs or solo 401ks. Um, and we've certainly helped many of our clients invest using those assets as well. So while conventional financing is the most popular method of acquiring investment property, it's not the only method, and it's not the only way you can acquire investment property. And here's a snapshot of private financing terms. You'll notice that we're talking about down payments of around 40%, interest rates between 6.5% and 8.5%. Definitely higher than conventional financing terms, which are around 20 to 25% down payments, about between 4 and 5% interest rates. So I always recommend conventional financing if you can qualify for it. But if you'd like to leverage and cannot qualify for conventional financing, then you're still able to take advantage of private financing terms such as these. So now we're going to move into my favorite part of this presentation, and that's taking a look at actual markets and actual investment examples within those markets. Here we have data pulled from the National Association of Realtors for the 25-year appreciation trend for San Antonio. San Antonio is one of our most popular markets, and this is a phenomenal market for those investors looking specifically for appreciation. So I do want to point out how linear this trend is in San Antonio. There's some little bit of volatility, but in comparison to a market like Southern California or Florida, it's almost a linear line. And so this is a market I would recommend for investors looking for appreciation, investors who are risk averse, um, and certainly investors who are looking to stay within the $175,000 to $225,000 price point, because as you can see, the median home price in San Antonio is right around $228,000. So let's take a look at an actual example within this market. I just pulled one off of our website a little earlier today. New construction home in an A-class neighborhood in San Antonio listed at $220,000. The first box that you see on this evaluation is going to be calculating the investment capital that you need for this specific home. In this case, there's a down payment at 25%. You can go as low as 20% with conventional financing, but 25% will give you a better interest rate. And then estimated closing costs at 3%. Those include your title fees, your escrow fees. In this case, with new construction, sometimes the builder's lender will actually cover some closing costs. But again, these estimates use very conservative numbers. The next box is going to calculate our fixed expenses specifically. So we have our gross rent factored in here of $1,650 a month. That's determined by our property managers in San Antonio, who have already leased and managed property within this, certainly within the market, but even within the neighborhood. Then we subtract all our fixed expenses. Um, as you can see here, $1,338.12 a year. And that's determined by taking the actual insurance rate for this property, the actual tax rate for this property, actual mortgage payment, um, and essentially adding them up. These are the expenses we know we're going to incur for a property such as this one. Now, our gross rent less our fixed expenses gives us our monthly income, correct? $311 a month. Now, some might say that that's your cash flow, but again, remember, we're evaluating conservatively. And if we say that $311 a month, taking these fixed expenses into account as our cash flow, then we're ignoring the fact that we do have maintenance and vacancy expenses that we do want to account for. So you'll see that our projections take into account an adjusted monthly cash flow based on the property's property class. Because this is not only an A-class property, but a new construction property, we default to 8% maintenance and vacancy, and we actually lower our maintenance projection just a little more because it's a new construction property, showing a monthly cash flow of $51.54 a month. Now you might say that that's not an astronomical number, and I would agree with you, but if you take a look here, you'll see that this property has a 15-year projected return on investment of 21.57%. Now, how can that be with cash flow at $50 a month? Well, I would recommend San Antonio, like I said, to those investors looking specifically for appreciation or specifically for the highest return on investment possible. And to evaluate the highest return on investment, we don't just look at cash flow, we also look at projected appreciation and principal pay down, how much of your mortgage you pay down over a fixed period of time. We default to 15 years. In this case, we find many of our investors do hold for an average period of 15 years, some less, some more, and these are adjustable factors on our website as well. And like I had mentioned earlier, there's specific metrics that are going to be most applicable to certain investors depending on what you're looking for. So those investors on the line today that are looking specifically to maximize their return on investment, regardless of where that return is coming from, cash flow, appreciation, or principal pay down, your annual return on investment is going to be the metric that's going to be most important to you in evaluating any real estate investments in any market. And that number, that 21.57% that you see there, is simply determined by taking the total profit from your sale over your cash invested over the number of years you hold that property. So let's take a look at what that looks like. Here we have your total projected profit. Now this is a snapshot from the returns on our website. This property has a total 15-year projected profit of just under $200,000. Now take that number divided by our initial investment capital, $61,600, divided by 15 times 100 will give you annual return on investment of 21.57%. Now this total projected profit is broken down, like I said, by taking your total accumulated cash flow, this $9,277.66, that's simply this $50 times 12 to give you your annual cash flow, times 15 to give you your total accumulated cash flow, never taking into account any increases in rent, adding that number to our projected appreciation over 15 years. In this case, we're saying this property is going to appreciate about $170,000 over 15 years, and that's taken from the trend line we evaluated here. And you can see even this 25-year historical data is San Antonio is appreciating about 4.5% per year, even based on this data where our appreciation projections come from, we've adjusted our accumulated appreciation to 3.88%, ultimately determining your 15-year accumulated appreciation of $170,000. Now going just a little bit further here, you'll notice that we have principal pay down for our mortgage over 15 years. You pay down your principal about $55,000. Adding all of these up, you get your total return for this real estate investment. Of course, we have to subtract our selling expenses to have a conservative and realistic number. Comes to about $199,350 projected over 15 years. Now that number divided, like I said, by our initial investment capital of $60,600 divided by 15 to give you an annual percentage gives us a return on investment of 21.57%, which is astronomical in terms of market returns. But I do want to point out that this is why it's important to determine what it is that you're looking for as an investor, because if you're looking for tangible cash flow, then this is not the best investment for you. As you can see, very little of our returns coming in cash flow, and most of it is coming specifically from the very slow, steady, conservative appreciation in a market like San Antonio. Now compare that to a market like Clarksville, Tennessee, where the appreciation trend is not as high. It's almost 2% less than San Antonio, but this is a market where the rent to price ratio is significantly higher. So this is a market I would recommend to those of you on the webinar tonight looking for cash flow specifically. Now, the metric, and I do want to point out that in a market like Clarksville, Tennessee, we also are looking at a median price point of $143,000, so even $100,000 less than a market like San Antonio. But this is a market that, like I said, would I recommend for those investors looking for cash flow. So we're going to evaluate a property using a metric called cash on cash return. Now you can see here this property available on our website at $114,900 sees a monthly income of $400 adjusted for maintenance and vacancy. We're seeing conservatively $175 a month in pure cash flow. Now that's compare that $175 a month relative to investment capital of $35,000 versus the property in San Antonio with lower cash flow but higher higher investment capital. Now you'll see here that the return on investment for this property is lower than the one in San Antonio because the market doesn't appreciate historically in the same way that San Antonio does. But in this case, if we're not worried about appreciation, we want cash on cash return or cash flow specifically, then we're going to evaluate this property based on a metric called cash on cash return. And this is simply our annual cash flow over our total cash invested. In this case, it's this adjusted cash flow number of $174.89 a month times 12 over $34,326.38 a month. Gives us a rate of about 6.11%. Now, what does that metric tell us? This is telling us that of our overall projected return of 17.43%, 6.11% is coming back to us in pure tangible cash. Not appreciation, not equity pay down your home, but actual cash hitting our bank account. So that's why if you're looking for tangible or passive income specifically, the higher this number, the better. Whereas if you're not looking for passive income immediately and simply want the highest return on your investment, annual return on investment is going to be the most important metric for you as an investor. And here's a quick snapshot again of those numbers on our website. Um, we often work off of the adjusted cash on cash return because it's important to factor in maintenance and vacancy. But there are certainly those investors who would like to look at the raw numbers where we don't factor in maintenance and vacancy expenses. So both cash on cash return projections are presented there for you. Now, this data and these projections are all calculated through our property financial calculator. This is a resource that is available to you for free on our website. Again, I'm more than happy to send this over. It allows you to input all of the financial data for any property in any market and see the returns, the projected returns for that property. And for the properties on our website, it's already done for you. For any property that you would like to evaluate, I'm more than happy, like I said, to send over the blank financial calculator. It's a great resource in determining cash on cash return and return on investment for any property and with any purchase method. So just following up this evening, I want to touch on property management because, of course, if we're investing out of state, we're going to be talking about utilizing a property manager. And if there's two takeaways regarding property management this evening, I just want to stress that your property manager can, like I said, take a high performing asset and turn it into a poorly performing asset. So definitely know who you're working with, interview different property managers, make sure the best fit for you and your assets. Avoid conflicts of interest. So make sure that, for example, they don't charge a management fee if your property is vacant. They then have no incentive to lease your property as they're getting paid and you're not. And make sure that maintenance is not a conflict of interest. If they have in-house maintenance, then often they look to maintenance as a source of revenue. So at Marshall Reddick, for example, our maintenance is coordinated through third-party vetted vendors. You do have the option to use your own as well, but it is not a source of revenue for us and thus not a conflict of interest when we're doing, for example, any renovations or a rent ready to place a new tenant. So keep those two conflicts of interest in mind. Make sure that you're taking a look at sample property management agreements, lease agreements, so you can fully vet any property manager that's going to be managing your asset. And a quick snapshot of our fees, very simplified fee structure. Often any property 1 to 4 units, you're going to see a monthly management fee of about 7%. And again, I can send over this resource in addition to all resources that we talked about tonight following this webinar. So I won't go in too much into what a property manager does. I know we're running a little late here, but again, I am available following to go into more detail about many of the concepts and points that we're talking about tonight. Of course, we evaluate property knowing full well that we have vacancy and maintenance. There are other risks in investing in real estate, including fluctuations in value and natural disasters. But we can always hedge against those risks, maintenance and vacancy, by investing in the correct market and using the right team, a carefully vetted team. But property values in putting a proper down payment, which is actually required now by conventional financing guidelines, and having proper asset coverage to protect against natural disasters, and that's specific to certain markets like Southwest Florida, where, for example, hurricane insurance is required, and not many investors know that. So as long as you're doing the proper due diligence, evaluating conservatively, you can hedge against many of the risks associated with real estate investing. So we'll do one more quick poll to close out this evening. I appreciate you guys sticking in there. I know we're running just a little bit late, and then we'll send you off right ahead of a holiday weekend, or I'm sorry, a holiday week. So next question: ideal time frame for your next investment. Again, completely anonymous. We're um, not going to be posting these results nationally or anything like that, but does give us a good idea of who we have on tonight. All right, it looks like a majority of us on the webinar tonight are looking to acquire our next investment property um, within the next year, and that's phenomenal. Some of us a little longer, and that's great too. I hope this can serve as a bit of a jumping off point, opens up your realm from maybe not just the state of California or your city to the whole nation, and specifically the 16 markets that we shared a little earlier. And again, I know a lot of the concepts we went over this evening um, are new and do require additional explanation. Myself as an advisor, I work with clients directly to evaluate their specific financial goals, quantify them, and then open up different markets and investment opportunities specific for them. So all of my contact information is available there at the bottom of your screen. You can also coordinate a consultation directly on our website at the link above. If there's any resources that we went over tonight that you would like to be sent over directly, feel free to email me, text me, call me. I'm more than available. This is what I do day in, day out, regardless if you're looking to invest next month or in the next 2 years. You can always start the due diligence. You can always begin in evaluating investment opportunities and different different markets and properties within those markets. So when the time comes to invest, you've done your due diligence ahead of time. Um, and with that, I would just like to thank you all for being on the webinar tonight. Thanks for sticking with us, even though we ran a little late. Hope all of you have a phenomenal evening, a great Thanksgiving, and I am looking forward to speaking with you soon. Thank you.